As we enter 2025, the banking landscape in the United States continues to evolve dramatically. Traditional brick-and-mortar banks are facing unprecedented challenges from digital transformation, changing consumer behaviors, and economic pressures. Today, we're going to examine the 15 U.S. banks most likely to close branches in the coming months, and more importantly, understand why this trend is accelerating. Let's start with some context. In 2024, we witnessed over 3,000 branch closures across the country, marking one of the most significant years of consolidation in banking history. This isn't just about cost-cutting. It's about a fundamental shift in how Americans interact with their money. First on our list is Wells Fargo, which has already announced plans to close 250 branches this year. The bank's strategy involves consolidating operations in urban areas where they have multiple locations within close proximity. What's particularly interesting is that Wells Fargo isn't just closing branches. They're reinvesting those savings into digital infrastructure and AI-powered banking solutions. Bank of America comes in second, with projections showing they'll likely close around 200 branches in 2025. Their approach is slightly different from Wells Fargo's. They're focusing on closing branches in rural areas where foot traffic has declined by more than 60% since 2019. The bank has been transparent about their digital-first strategy, noting that 85% of their customers now primarily use mobile banking. Citibank ranks third on our list, and their situation is particularly interesting. They're looking at closing approximately 150 branches, but they're doing something unique, converting some traditional branches into what they call digital-first advisory centers. These locations will have fewer tellers, but more financial advisors and digital assistance kiosks. U.S. Bank, number 4 on our list, is taking a more aggressive approach. They're targeting 175 branch closures, primarily in the Midwest, where they have significant overlap from recent acquisitions. What makes their strategy notable is their partnership with retail chains to maintain some physical presence through mini branches in grocery stores and shopping centers. Fifth on our list is PNC Bank, which is expected to close around 120 branches. Their strategy focuses on major metropolitan areas where digital banking adoption is highest. They're also investing heavily in AI-powered ATMs that can handle 90% of traditional teller transactions. KeyBank comes in at number 6, with plans to close approximately 100 branches. They're particularly focused on consolidating in the Northeast, where maintenance costs for older buildings have become prohibitive. However, they're also investing in mobile banking technology that allows for video conferencing with personal bankers. Seventh on our list is Truist Financial, formed from the merger of BB&T and SunTrust. They're looking at closing around 90 branches, primarily in areas where the merged banks had overlapping coverage. Their approach includes maintaining larger flagship branches while closing smaller locations. Citizens Bank ranks 8th, with plans to close approximately 80 branches. They're focusing on urban areas where mobile banking adoption is highest, but they're also introducing innovative solutions like portable pop-up branches for seasonal locations. Regions Bank comes in at number 9, with projected closures of 75 branches. Their strategy involves maintaining presence in rural areas where digital adoption is lower while consolidating in urban markets. They're also experimenting with automated branches that operate 24/7 with minimal staff. TD Bank ranks 10th, planning to close around 70 branches. Their approach is interesting because they're actually expanding in some markets while contracting in others, following population shifts and banking behavior changes. M&T Bank is 11th on our list, with plans to close approximately 60 branches. They're focusing on optimizing their network following recent acquisitions. particularly in the Northeast and Mid-Atlantic regions. Huntington Bank comes in at 12, looking to close around 50 branches. Their strategy involves maintaining their strong Midwest presence while optimizing their branch network for efficiency. Fifth Third Bank ranks 13th, with plans to close approximately 45 branches. They're focusing on urban markets where digital adoption is highest while maintaining their presence in rural areas. Capital One is 14th on our list with plans to close around 40 branches. Their strategy is particularly interesting because they're already heavily focused on digital banking, and these closures represent a continuation of their tech-first approach. Finally, BMO Harris Bank rounds out our list at 15, with plans to close approximately 35 branches. Their strategy focuses on optimizing their presence in the Midwest while investing in digital capabilities. What's particularly fascinating about these closures is the underlying trends they reveal. First, we're seeing a clear urban-rural divide in branch closure strategies. Urban areas with better internet infrastructure and higher digital adoption rates are seeing more closures. Rural areas, while not immune, are seeing more selective closures, with banks often maintaining at least one physical location in these communities. The economic impact of these closures is significant. Each branch closure typically affects between 5 to 10 employees directly, but the ripple effects on local communities can be much larger. Small businesses, which often rely on personal relationships with local bank managers for loans and financial advice, are particularly affected. However, it's not all doom and gloom. These banks are reinvesting significant portions of their cost savings into digital infrastructure. Mobile banking apps are becoming more sophisticated, offering features that weren't possible in traditional branch banking. AI-powered chatbots are handling customer service inquiries 24/7, and blockchain technology is making transactions more secure and efficient. The future of banking is clearly hybrid, combining digital convenience with human expertise when needed. Banks are experimenting with video banking, where customers can speak with financial advisors from home, and mobile branches that can serve communities on a rotating basis. Looking ahead, we can expect this trend of branch closures to continue, but perhaps at a more measured pace. Banks are learning that while digital transformation is essential, maintaining some physical presence is still valuable for building trust and handling complex transactions. For consumers, the key is to stay informed about these changes and adapt their banking habits accordingly. Many of these banks are offering training sessions for older customers to help them navigate digital banking tools. They're also maintaining partnerships with local organizations to ensure vulnerable populations aren't left behind in this digital transition. The banking landscape of 2025 and beyond will look very different from what we've known. But these changes aren't just about cost-cutting. They're about adapting to how people want to bank in the modern age. The challenge for these institutions will be maintaining the personal touch that has traditionally defined banking while embracing the efficiency and convenience of digital solutions.